employees sitting down every year and walking through each of their family values and which ones were most important, the ones they wanted to work on for the year, and just the amount that he has his kids involved in kind of drove me to want to spend additional time than what I already do driving those values home, what they truly mean, and how we actually interact with those values in our daily lives.
Welcome to the Wealth Strategy Secrets of the Ultra Wealthy podcast, where we help entrepreneurs like you exponentially build wealth through passive income to live a life of freedom and prosperity. Are you tired of paying too much in taxes, gambling your future on the stock market, and want to learn about hidden strategies for making your money work for you? And now your host, Dave Wolcott, serial entrepreneur and author of the best-selling book, The Holistic Wealth Strategy.
How's it going, everyone? Welcome to another episode on Wealth Strategy Secrets. In this episode, we had the pleasure of hosting Ian Djuric, a titan in both waste management and real estate. Ian's journey from scaling waste management to overseeing the Djuric Family Office's vast portfolio offers invaluable insights into rapid, scalable growth and efficient operations. Ian's career trajectory is a testament to his prowess in transforming companies into multimillion-dollar ventures and his unwavering philosophy on wealth and the family office. During our conversation, Ian shared insights into his strategies for driving growth, managing operations, and fostering a culture of excellence, as well as his strong core values that are the foundation to all his ventures. Ian's story is an inspiring testament to the possibilities of visionary leadership, meticulous operations management, and unwavering dedication. Tune into this episode for a masterclass on scaling businesses and wealth for sustained success. Ian, welcome to the show.
Thanks for having me, Dave. I appreciate it.
Yeah, you bet, Ian. I know the audience is really going to enjoy hearing about your epic journey through the waste management business as an entrepreneur, really scaling those businesses and getting into, real estate and really, what you're doing today in terms of, your family office and being an operator and everything. Super impressive background, and I think people are going to really enjoy, hearing that story. So why don't we start there and, just take us back a little bit, talk to us a little bit about, your background and how you got here.
I'm essentially a street hustler that made it big. That's it. Plain and simple. But no, I started off on the street. I was a door-to-door sales guy in the waste and recycling industry. I was sitting there at my door. Someone came, knocked on it and said, "Hey, what's going on?" I said, "Hey, nothing much. What you want?" It's like, "Hey, just selling trash service door to door. Are your parents home?" "Nope, can't help you." It's like, "Cool." He's like, "Hey, do you want a job by chance?" I'm like, "No, I'm making $6 an hour. I am great." It's like, "Well, hey, I make about $1,000 a week." And that stopped me in my tracks. And this was way, way back in the day. And $1,000 a week was insane. So I was like, let's do this. I'm going to go see what door-to-door is all about. So the next day I went out, watched this kid make $300 in a day, and I was hooked. I was like, how do I continue to do this? So went out there, spent the rest of the summer selling door-to-door, doing phenomenally well. Best life lesson ever, because you learn how to take a no so immensely quickly, because 80% of the people just slam the door in your face, curse you out. My favorite one is like when you go up, you knock on the window, and you're kind of looking in, and they walk up, they peer in, they see you, they wave at you, and they just keep walking by and just like, "Hey, cool, not coming." Just nice and polite. So just turn around and walk away. But it was a phenomenal time to learn how to take a no and get some really core basic sales skills, because you're having 80 to 90 sales interactions a day. So highly recommend door-to-door for anybody who wants to get a career in sales. It was a phenomenal learning for me. But got smart and wanted more. So I started my own sales company. We had 144 kids doing door-to-door and business-to-business sales for waste and recycling companies up and down the East Coast. We worked for small companies, so we also worked for bigger companies like Republic Services. I think they're the $9 billion second biggest trash line company in the U.S. Went to college, eventually got smart and understood what reoccurring revenue was. It was great making several $100,000 a year doing the door-to-door, running my company, and I was killing it in college. But I kept seeing this trash. I go, hey, you know what? I'm sending people to contracts, and they're getting that monthly revenue every month, making profit every month, theoretically forever. These contracts auto-renew. So I'm like, let's be smart. Let's go ahead and do this. Go for it. So I started my first trash recycling company from the ground up. We were bootstrapping it with about 400 grand. It's like 400 grand. And we came in strong. The sales team was absolutely destroying it. Big local trash guy said, hey, Ian, come to my office. This is about 3-4 months in. And I was like, cool, what's going on? Like, I'm new to the space. It's my first big meeting, per se. And he sat me down and he's like, hey, Ian, thanks for coming in. I'm like, cool, is that a beer? I'm going to buy your company today. And I sat back and I was like, wait, this is a surprise? Like, it's cool. Not what I thought we were going. We're also not for sale, by the way. Never even crossed my mind to sell something. So it's real simple. I've done my market research on you. You're a phenomenal sales guy. You're great at customer service. You guys are going to come in and do an absolute ton of damage to this market. But you're bootstrapped. You can only grow as fast as the money that you have. And you're eventually going to peak out and then have to take money in. So here's my solution. I'm going to give you $5 million to go away. Because it's going to save me a lot more money than it is to have you come in and take way more than my customers. So $5 million should be a lot for you. But he broke it down to me really simply. This is a 2-hour conversation. He's like, hey, take $5 million, go to a different market, and then look at your ability to grow off of that $5 million versus you trying to grow off of the $400,000 or $500,000 that I had. And I was like, that would simplify my life, allow me the greatest bootstrap ever. And I wouldn't have to take on any kind of investors for the near part of it because we had a great base to it. So after a couple of weeks, we took the deal. We moved over to a different state, started up, and we ended up building one of the top 100 trash recycling companies in the US. Never took on an investor and took a big exit. Sorry, so super long story today. Sell the trash company, and we've been an LP or limited partner for a long time. Obviously, very big trash company, doing very, very well. We were a limited partner in venture debt. Obviously, we had stocks and bonds like everybody else has. LP in a variety of real estate, from self-storage to multifamily. And we had a whole bunch of single-family homes I just started collecting up because that was apparently the thing to do, was to own small residential real estate. And it was kind of the bane of my existence was running those single-family homes. And because I didn't have a system, I didn't have a process, I was just snapping them up, putting long-term tenants in them as fast as I could, and then I was just outsourcing all of the hard work and the rent collections. It's not the best system, but we were accumulating wealth, right? Sold the trash company. I really kind of sat back and I was like, what do we want to do now? How do we pivot? How do we grow? How do we start a new company? And I absolutely loved multifamily, from being a passive investor in it, watching the systems and the processes and how they get to scale, because it was a similarity kind of how you grow another kind of company. Different class of assets, but growing one empire to another has a lot of similarities into it. So I sold all of my single family homes, and I went to my 2 favorite multifamily sponsors. And I said, hey guys, here's the deal. I'm going to fully fund your deals. You can keep your fees, keep your promote, your profit sharing, it's all yours. But I'm going to run these and you can babysit. They were a bit shocked at first, but getting a fully funded deal from one person is not a bad deal, especially when I didn't want anything special. I was willing to take the deal as is, no negotiations. So after a couple of weeks, we agreed to it. I spent upwards of $27 million and went to town the very next week. I started off just doing leasing. The number one core basic thing of all apartments is, again, a lot of apartments is sales. We have to lease our units. We got people to move in. And then the biggest thing is, we can talk about it later, but you make your money in the renewals, not in the original leases, right? All of our money is in renewals, so we get people to pay more to stay. So that was the biggest thing for me. We did that more than the assistant management role. Assistant management is delinquency and renewals, right? So then just kept working my way up into property management, then focused a lot more into the asset management side and construction. And definitely learned a lot of lessons about over-renovating, because I did a lot of that in about 20 units and did not get the ROI I wanted for the amount that we spent. So we spent a lot of time with sponsors, came back to a realistic market plan, spent about $9,000 to get about $225 rent premium. That worked out well, and realized I didn't have to upgrade things to an A-class standard on a 1982 product, right? So lots of great lessons learned. Was super lucky that I was able to do it with my own money, be able to afford to buy my education. I wasn't someone that would have done well in a syndication class or a weekend mastermind. I'm super hands-on. I still am today. So yeah, it's the core basic story. Fast forward to today, we have $2.2 billion in assets under management, primarily the Southeast and Texas, about 70% multifamily, and then some development and build to rent from there.
Yeah, really awesome, Ian. There's so many golden nuggets in that journey, starting off when, you actually just started, right? Which was hearing about really taking on rejection. And I find that that's so interesting, especially as we're all raising our kids today, right? And right down to the soccer field, right? Whereas everyone's a winner and in sports these days, and they're not letting kids even learn that lesson of, there's a winner and there's a loser, right? But you learn that lesson early on in learning how to handle rejection and everything, which is just, such a powerful lesson. And I think a lot of people today are even afraid, to take on rejection. There's always some kind of fear kind of holding them back. So I think really powerful lesson there. And then I think it's really insightful how you were able to just, be so hands-on and take all of your experience from the waste management business, right? And basically operating a business, and then bringing that into real estate and taking a totally unique approach to it by just, completely lifting up the hood and looking at everything inside and out. And, occasionally you hear stories about that, people doing that in the restaurant business. They're working everything from the waiter to the prep and the sous chef and all of these different things, because if you don't really have that experience, how can you direct teams? How can you optimize and things like that? So super unique approach. And basically 95% of the people out there aren't going to do that hard work, right, to get into it.
No, absolutely. To be fair, a lot of both those companies was, sure, I have a great skill set, but it was building those phenomenal teams. The team that we had, the trash recycling company, was great, and the team that we have now in place today is just, there's that book out there. It's I always forget the title of it. It's not how but who. It's something similar to that title. It's always
Who Not How.
Yes, thank you.
Dan Sullivan.
I love that book and love the concept, and bringing in a phenomenal team is really the key thing for a lot of our future success.
Yeah, for sure. And especially as it relates to wealth. And, it's really awesome that you've, created your own family office as well and created a structure around that. And what I found, speaking about, who, not how, when I kind of went through my journey too, anytime you would talk to a typical, advisor, it's either an assets under management stock advisor, right, who can only recommend the products that they're selling to you, right? So they're not really being, a true fiduciary. Or when I exited my business, I got all kinds of recommendations to, here's an M&A attorney, here's the tax attorney, you should work with, but they don't know anything about, true tax optimization, right? And a lot of strategies, that are really out there, for business owners and everything. So it's really such a key concept, not only who, not how, but really building a dream team, around your wealth, that's going to support you on the journey wherever, you are today, and wherever you want to get to. Just, you get so much leverage by bringing in that specific expertise.
I'll give you a wild story on that exact topic. I was with my dad this past week in West Palm Beach, Florida, and he has considerable wealth as well. Not the same scale, but has done very, very well in his life. He has an advisor at UBS. My dad has 10 figures in stocks and bonds there. And his advisor never recommends anything that's not a stock, bond, or something in that overall UBS stock portfolio that he runs and manages. Yet at the same time, Blake works with UBS for alternative products. Like, we can get our syndication or deals done through UBS clients. But because my dad's advisor isn't involved in those kind of deals, he doesn't share any of them, because he would lose his profitability on my dad's portfolio by having to invest outside of it. So it's a lot of this, again, ensuring that somebody truly is a fiduciary and has access to everything that you should be able to have access to, regardless of their end means.
Yeah, such a great story. Can you tell us a little bit of, what was your, inspiration really to create a family office? And there's so many different structures out there when it really comes to that. So I know it's kind of confusing for a lot of people, but, what was really the vision that, you had for yours?
So two parts. I mean, starting the family office was, once you realistically get 30 million or 9 figures, your wealth is going to affect future generations for the most part. Unless you go spend all your money in yachts and planes, your wealth should take care of future generations, or at least affect it in a positive way. So kind of forming the family office was to force myself to not be an entrepreneur, but to be a realistic future planner for myself and for my family. I'm generation one, which means I have this huge amount of capital that I've worked incredibly hard for, but I don't have experience, or previously didn't have experience managing that kind of capital, being a alternative investments person. So we set it up into a very kind of more safe haven, more of a hub and spoke model for it, but we still have a lot to go in terms of planning for how we're going to allocate out for kids. Whether do we let children touch principal? Is it just interest? Are they allowed to manage themselves? Is it going to be done through everybody else? But it's a mix of a living trust, irrevocable trust, a charitable trust. There's a large amount of structured trust within our main profile. And we could probably talk for 2 hours on structuring all those different trusts. But a lot of ours is still yet to be done, to be very fair. Primarily because I'm 38, and where we're kind of going with the wealth and growth of the different companies is still kind of to be determined. My kids are 8, 7, and 5. They're still way too young to get involved. I think we're still trying to teach them or introduce them to what wealth is as a concept, and eventually kind of move in. So, for example, we met up with a great family office up out of Tampa, third generation. One of the sons was 35, 36. They're worth about $800-ish million. And the younger generation all works in the family office. They're associates or whatever titles, like fancy title you get at that stage. And he wanted to invest in a deal or do a JV with us, but his family wouldn't give him access to the capital directly. He came, met with us, and we had to go meet with 5 other people and actually sit down with his dad and their CFO and other people. And that led me to think of, how is that going to help me structure my family office? Like, my kids are involved every day. Do you give them access to principal? Or do you allocate a set number of profits or exits a year that come along that goes into a money pool to go to them, allow them to kind of allocate their own bucket? So I want my kids to be involved early, but at the same time, as soon as you let somebody touch principal, that's how you lose money. So big mindset shift for me of watching it happen to other people, watching frustration, watching excitement, and then how do I learn these lessons over the next 10 years so when my kids start turning 18, 20, I can implement a structure appropriately for them at that time.
What if everything you thought you knew about investing was wrong? Would you like to create a wealth strategy like the top 1% have and get exclusive access to top private equity deals that provide downside protection, tax efficiency, predictable cash flow, and have a lucrative upside? Discover how with the Pantheon Advantage and join our investor club today at pantheoninvest.com.
Yeah. The statistics out there are really not pretty, and that, 75% of wealth is actually lost in G2. And by G3, it's actually 90%. So it's so great, that you've proactively, taken on kind of a strategy. And what I find really fascinating, about the whole family office space and this concept, and, look, even if you don't have 30 million and you only have 1 million in net worth, you can still use a lot of these principles as well. And one of the biggest principles, I think, is really, creating like a family constitution and creating values in your family. And as entrepreneurs, right, we all do it in our business. It's one of the first things you do, right? It's creating this vision statement. We've got a corporate culture, we've got values, and we're trying to live it and incorporate it into our businesses. But not everyone is doing that with their families. And what's most important? right? It's your family, because I think if you can really nail those value pieces, and then the mindset piece, I think that's really going to help people, retain that wealth in future generations.
I couldn't agree more on the value set. It's really having the kids be involved in the creation of those values or adjusting those as you go along every 5-10 years. But I was talking with Logan Rankin last week in Naples, and he was going through how he has kids in similar age ranges. I think they're a year or two younger than mine, but just literally sitting down every year and walking through each of their family values and which ones were most important, the ones they wanted to work on for the year, and just the amount that he has his kids involved in kind of drove me to want to spend additional time than what I already do driving those values home and what they truly mean and how we actually interact with those values in our daily lives.
Yeah, for sure. It's actually, we're recording this here right before Christmas, and it's one of the opportunities that I'm going to take because my kids are a little bit older, in their 20s right now. And, I'll tell you, if you don't get those values in place by the time they even hit high school, it gets increasingly harder, right? Because they go their own ways. They don't want to listen to what mom and dad have to say. But, we're trying to take every opportunity we can to reflect on those values, to have, examples of how we can live those in our daily lives. Gratitude is so important, having that vitamin G on everything we do. And it's interesting because I've found that we have 4 kids, but as diverse as our family is, the one thing that cuts through all of the noise and everything is value systems. Because if you can hold that really core, that's at the essence that cuts through these issues that sometimes can seem, so emotional or so divisive and things like that.
No, absolutely to that. Here, you can answer a question for me for this one, Dave. We're sitting down talking about upcoming Christmas now, and one of the struggles I have with my 2 oldest, they're Irish twins, both born the same year, 8 and 7, is we're always talking about like family first, like always having your brothers and sisters back, kind of regardless of the situation. So they're both in elementary school at the same school and different friend groups, different likes and activities. And occasionally one of them does something stupid or goofy, the other one's like embarrassed by it, or someone might make fun of them for something, but it's having each other's back regardless of what they did, no matter what. What kind of value would you call that?
That might be loyalty, I think. I think I would probably put that under loyalty. Is a good one.
No, that's my biggest thing for the challenge of the year is focusing on just having that loyalty to the family. Obviously, it's great to ensure that we all do the correct thing, but regardless of people make mistakes, just always being there for each other, kind of no matter what. Because none of us are perfect. We all make mistakes on a daily basis.
Yeah, exactly. And I've found that, just using examples or storytelling is super helpful, with the kids so that they can just kind of get it at whatever age that might be for the kids, but just creating those real examples of how to do that can be pretty powerful. So really good stuff. Let's transition a little bit into your real estate and tell us a little bit more about your view on real estate right now as an operator. Super challenging year on the real estate front, especially with multifamily, what's going on with interest rates and things like that. We're hoping rates are going to come down next year, but what are your thoughts if you could share your crystal ball into 2024?
I mean, everything's presumption. Everybody has their own opinions on it. Happy to share ours. So I'd say 2023 is probably our slowest year. Probably the second half of 2022 into 23 is probably our slowest year in terms of doing deals, especially in multifamily. I think we only did one multifamily deal, which was the Bexley in Iowa. Since then, I think that's the only one we did. Multifamily is extremely difficult time right now, especially if you're using JV or institutional equity. They require 6 in and 6 out, which nothing will underwrite to, regardless of what you want to do. It just won't underwrite to that. So JV equity is sitting on the side. Would love to get into it, love to buy more units, but you're just not seeing the distress. Like people are looking for the 07, 08 distress, and we're not seeing that. Even if you are buying a deal from the bank back at someone losing all of their equity, that deal is still not necessarily priced appropriately. You could be coming in and buying something that's still $10,000 or $15,000 a door overpriced just because somebody paid dramatically overpriced in early 2022 and give it back. Doesn't mean you're getting a fair deal. It may hypothetically be a discount to 21, 22, but it doesn't mean it's correct in today's value and you're actually getting a discount. You can still be overpaying by 15, 20%. We were pretty big in build to rent in 21, in early 22, and we've kind of made a big pivot exit. So we work with Yield Street a lot. They have a pretty big portfolio across the board as well in the space. And when we were underwriting build to rent exits in 20 to 22, obviously institutions were buying build to rent spaces at 3.5 caps, 4 caps, absolutely phenomenal return rates. And even if we were underwriting to a 5, ourselves to be conservative at that time, right now you can't exit that profile. You're looking at a 5.5 to a 6% exit cap kind of across the board, strategically depending on where you're at, whether it's Huntsville, Florida, Orlando, Houston. So we took the pivot of let's take a safe exit. Lennar, D.R. Horton, Ryan, all the big builders, even the smart local ones, are in a massive need of lots for upcoming 24. And they want these neighborhoods to do build to sell versus build to rent. So we got one offer in early. I was mentioning Yield Street, so they're a partner of ours, and they've been doing this on a couple other assets already. Said, hey, like this is an option that we've been doing across our board. There are equity in deal, like we think this should be a good exit as well. And we've seen some sheets, but weren't quite sure. We take the early exit, we push it through, and we're going to exit about 1,200 lots, or would have been build-to-rent home sites from Savannah, Huntsville, Winter Haven, Florida, and we're going to return about a 24 to 27% IRR just selling the lots. So we'll exit in about 2 to 2.5 years versus the 5-year plan. But again, it's all about pivoting in the right position to taking a safe exit, taking a return, and then not being able to redeploy that capital in a space we kind of have a better understanding of where we're at, where we're going to be at for interest rates going forward somewhat. Self-storage, we're pretty bullish on new development because most people want the climate control and the ability to kind of add on. The 1990s, the older product where it's all just, you roll up with just the non-climate controlled roll-ups, just dirt all on the ground, or even if it's paved. We just don't see the ability to kind of create value or just force rents up in today's environment or thing on there. So we're kind of letting that sit and dry. And obviously our biggest specialty has kind of been in new construction, primarily in condos. I think trying to do multifamily new construction in today's environment is incredibly difficult because of interest rates, you're almost at 10 to 11% on new construction debt, and you're going to have to carry that because it's at a variable rate. And then 2 is, I don't know how in the world you forecast a multifamily development cap exit in 3 years from now. So the risk profile and having to lever up your stack with multifamily development just doesn't hit a profile for us. But we've done pretty well with our Nativo and Lofty projects. Successfully raised for those, and we have 2 more upcoming in 24 that we're rather excited about. Again, those are a little bit easier for us because we pre-sell those and then we build them, so take away a lot of the risk profile. But very excited for 24. We'll see what it holds for multifamily and obviously interest rates. We'd love to buy more, but depending if the Fed drops down to 4.5, or we're still seeing rates at 5.7, 5.6. So kind of excited to see where it goes.
Yeah, what specifically would make you a buyer in multifamily in 2024?
I think a lot of this is what our investors require. So from an institutional investor, they require kind of that 15% IRR kind of driven at a minimum. They want you to be able to have a successful underwritten exit at a 6 cap sales price. And if I can underwrite to that, I'm a buyer all day because we have hundreds of millions of dollars of capital waiting to come into these deals if we can underwrite to it. So that's probably the biggest thing. I think a lot of it's also going to be the right situations, because I think there's still a lot of builders out there who have built brand new, beautiful product that finished in 22 that they were looking to sell at these 4 caps. Or we own a property in Friendswood, Texas. We bought it for $220 a door, late 21, and they built I think it was sort of Baybrook. They built behind us. It's a little bit nicer. They're both Class A products, obviously. And their original price was 282 to exit. That's what they plan to come in and sell for. They tried to sell about a month and a half ago. They kind of maxed out around 220 a door. So over $50,000 a door less what they wanted to. And they ended up not selling. But a lot of these equity groups that are in these deals don't want these, they're not operators, they're builders. They're merchant developers. They come in, they build multifamily, they lease up as fast as they can, they leave plenty of meat on the bone for us to come in, buy them, move up rents to market. But they're stuck operating because they can't exit at the pricing. And I think a lot of the equity groups are going to say, hey, you know what? We don't want you to operate this project for another 2 years. I'm also stuck in this terrible debt that I'm going to have to pay off. There's me no cash flow. And my 3-year hold now is going to turn into a 5 to 6 year hold. And my IRR every year is just ticking down because of the longevity of the deal. So I think a lot of people like Carlisle and some of the other bigger groups that have been to equity for us are going to say, hey, you know what? We're going to take an 8% return, a 10% return. Let's exit, take your money back, and go redeploy into a more realistic new build scenario. And I think being able to snap some of those up at a phenomenal basis level will make me a huge buyer. We love the new product. We love A-class, obviously, because we're right around a 32% expense ratio versus you look at C-class or B-class, you're at a 45 to 55% expense ratio. So really love to be in that 30s and have the ability to kind of come in and get some realistic cash flow on the Class A new dev stuff. Those are probably the two scenarios in which we're a very excited buyer.
Yeah, really insightful. And are there any specific markets? Are you still feeling strong about those markets you've been operating in historically? Do you feel that those are going to be bubbles in the southeast or southwest, or are you still focusing on those markets?
I don't think things are going to bubble as much as people are kind of saying. So, like, for example, we have 3,000 units in Houston. I still love the market. However, you look at insurance, one of the biggest reasons we're able to survive in that market, where some people went from $500 a unit to $2,200 a unit and got absolutely wrecked, is we have these big national insurance policies across 5,000 or 7,000 units, or we're able to do one-off things with smaller local insurance providers in those areas. Well, people not. But with that and property taxes and the overamount of fraud in Houston, I don't think we're a dramatic new buyer in Houston this time. Do I still love Texas? Yes. Maybe a little Fort Worth, Dallas suburbs. We're always a suburb buyer. We're not an urban buyer. I'm not a high-rise multifamily guy. It's not our concept. But I still love Texas. I still like Jacksonville, Florida. If pricing comes down a little bit further from where it is. I still like the burbs of North Carolina. We're past on South Carolina at this time. We're past on Vegas. Done very well with our latest deal in Iowa and watching a bunch of other deals. Just the rent growth people are achieving in the Midwest. So we team up with a great operator called Chris Salazar, who's done 7 deals in Des Moines, Iowa. And that's kind of how we wanted to enter the market with another seasoned operator so that we weren't just one-off by ourselves trying to run the market. So we came in, teamed up with him, and that deal's going phenomenally. The organic rent growth is off the charts. We were underwriting to $135 in rent premium with a renovation. I think we're really spending about $6,000 on those. We're getting $145 to $150 in just organic rent growth. And then when we do the renovation, we're achieving about $230 to $225 with the renovation. So super excited to kind of explore the Midwest further just because of the opportunities and rent growth there.
Wow. Yeah, really, really interesting thoughts there. Ian, if you could give just one piece of advice to our listeners about how they could accelerate their own wealth trajectories, what would it be?
That's such a tough question, but I'll give it from a personal standpoint versus an overall thing. And people may disagree with it. I'm okay with a little bit of risk. It's okay to be a little bit uncomfortable in what you do. Take a small portion of your allocatable money and take a little bit of risk with it. My dad's return profile off his 8 figures in the stock market is 4% a year. And he's super happy, safe, and comfortable, but he's not creating wealth. If you allocate even $1 million of that into a hard money fund at 11%, the amount of wealth creation you're making, if you let that money combine and continue to grow, and even if you're not taking the cash out, you're trying to accumulate and grow on top of that or compound, you're really trying to create wealth. So don't be afraid to take a little bit of risk.
Yeah, I really love that, Ian. I was actually just reading a book this week that really talks about the psychology and the fear of change and how strong that is for humans, right? And it actually becomes really your subconscious, and we will do anything to avoid, change in our lives, right? And as much as we're talking about alternatives and real estate on this show, I know there's a ton of listeners out there who still have, the majority of their asset base in government sponsored qualified plans or in the market. And especially right now, right? I mean, we heard at the family office conference the other week, I mean, there's definitely a correction coming in the market. I think that's for certain. Could be, pretty significant as well. So there is always some degree of risk, but, just like you said, just allocate some portion to taking on some risk, move out of your comfort zone and try to, learn something new. And then, see how it goes, right? And learn from there. So I really appreciate that. That's sage advice for all. And really appreciate you coming on the show as well, Ian. Some great pearls of wisdom that you shared, and I think that's super helpful for people to just learn on their own journeys wherever they are, trying to take some of those valuable lessons in their own lives. If people would like to, connect with you or learn more about what you guys are doing, what's the best place?
Best place is just our website, blakecapitalgroup.com, or feel free to shoot me an email, ian@blakecapitalgroup.com. Happy to kind of connect and offer value however we can.
Awesome. Thanks so much, Ian. Really appreciate it.
Thank you for having me on, Dave. I appreciate it.
You bet.
Thanks for listening to this episode of Wealth Strategy Secrets. If you'd like to get a free copy of the book, go to holisticwealthstrategy.com. That's holisticwealthstrategy.com. If you'd like to learn more about upcoming opportunities at Pantheon, please visit pantheoninvest.com. That's pantheoninvest.com.